Good afternoon, everybody, and welcome to the ETC education session for September 30th, 2015. Time is certainly flying by. The market has been on a bit of a tear to the downward side of late, so that has certainly posed some challenges in terms of the investing or longer-term trading environment. But fortunately, our market risk indicators have been screaming at us for a long time that the health of the market has been deteriorating, and as such, we're certainly well aware that we must have minimal exposure at this point in time. Today's session on the education front, I'm going to be looking at trade triggers. So let's get underway. Disclaimer first and foremost, the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether that advice is appropriate in light of your financial circumstances. Okay, so topic for today is trade triggers. Now, I mentioned this on the weekly analysis session on Monday morning, that up till this point in time, we had been sticking with a rule whereby we were choosing an on-stop entry level of 2 pips above the most recent medium-term peak. 2 pips is generally a fairly easy concept to remember. However, I think for consistency purposes, it makes sense to think about perhaps an alternative measure that might make more sense. Certainly, when we think about trading stocks in the Australian market, we don't have too many stocks that are perhaps priced in excess of around about $40 odd. By conversely, a lot of our universe is also covering the US market, where many stocks over there are well in excess of $50 or $100, some even well in excess of $1,000. So the whole concept of 2 pips really goes out the window. So from that point of view, really wanting to just make things consistent, simple to follow, so that when we're thinking about placing our entry orders, that it's front of mind, and from that point of view, something that we don't really need to think about too much. The more we need to think in terms of our trading, perhaps the more opportunity for other thoughts and things to come in and sabotage the whole process. So what I wanted to do today was just to go through a very simple checklist, a quick recap of what our trade triggers should look like, and also the use of a limit order and how is it going to be impacted by making this subtle change. So here we've got a long trade setup condition checklist, and by now everybody should be absolutely comfortable with the whole concept of price action, the importance of price action as a filter, but also remembering the other parts of the methodology as well. So if we just go through the filter conditions to start with, obviously we want to make sure the price is above our 21 period moving average, the 21 period is above the 63, and the 63 is above the 125. So our scans do that for us nicely along the way. The next line down, the 21 EMA is rising, and the 63 and the 125. Again, our scans do that, and that's something that can be programmed in very simply. We're also wanting to make sure that when we're looking at our scans that we've got a newly formed medium-term trough. So one of the requirements that we must have in place is certainly a medium-term uptrend. Now, of late, we have previously traded in stagnation phases. For the last 4 or 5 months, we've chosen to simply take breakout trades past previous points of supply, where we've been using our price action filter to make sure that the most recent medium-term trough is at or above the second from last medium-term peak. So that's something that certainly needs to be checked all the way through. The actual trigger conditions, as an example down here, a breach signal. So what we're wanting to do is place an on-stop order 0.5% above the point of supply. So if we go through and have a look at the chart on the right hand side, you'll see the number ones. We've got new medium term troughs being formed along the way, and remember that We only know that we've had a trough formed once we resume a short-term uptrend. So we're in short-term downtrend, short-term uptrend, and therefore forming a new medium-term trough. And we're looking at the position of the last medium-term trough relative to the second from last medium-term peak. So there's our last medium-term peak, the second from last medium-term peak, and it's clearly above. So from that point of view, the price action filter is being met. So really all we need to do is start thinking about where we're going to place our on-stop order. Now, rather than placing the on-stop order 2 pips above effectively the past medium-term peak, we've got to realise what these medium-term peaks represent. They represent points of supply. There's certainly not as significant a point of supply as a long-term peak, but nonetheless they do represent some selling in the market at a particular level. So from that point of view, we want to think about these areas or zones of resistance, zones of supply along the way. They're not paper thin. So from that point of view, it really doesn't make much sense to have an on-stop order that is really, in the sense of everything, paper thin. So from that point of view, the rule that we're going to implement is having an on-stop order which is set 0.5% above the point of supply. And that makes it really easy when we're dealing with stocks, particularly in the US, where there might be a stock that's $180 as an example, and rather than placing an on-stop order at $180.02, which is just really interacting with a bit of noise, but by entering an on-stop order, in that particular case, 90 cents above that level, so you'd be looking to get in at $180.90 as your on-stop order. But at the same time, we also want to continue using a limit, and we want to make sure that we use a limit, particularly in the more volatile markets, to minimise slippage. So that amount of slippage that we get by putting that limit order on there is going to be minimised. Now, when we're setting that initial limit, we're going to set that 1% above the point of supply. So in the case of if we were trading in the US and we had a medium-term peak at $180, we would be setting our on-stop order 0.5% above that level, so it would be $180.90 with a limit to, now what's 1% of $180? It's $1.80. So the limit would be set at $1.80 above $180, so that would be at $181.80. So we're still using that limit, as I said, to reduce the slippage, and by placing that on-stop order 0.5% above and a limit 1% above, we're providing a window, if you like, through which the trade can actually trigger. If we think down at the lower end of the scale, at as an example, $3. Well, $3, if we're using 0.5%, well, 0.5% of $3 is going to be 1.5 cents. So in that particular example, 1.5 cents above $3 is $3.01, or 301.5 cents. So that would be the on-stop order with a limit 1% above that, so a limit to, in that particular example, $3.03. So again, just providing that window along the way. Another aspect that I'd like everyone to consider is the reward to risk on every trade that you're looking at. It's really become very, very apparent that expectancy has a huge amount to do with letting your profits run and cutting your losses short. So certainly the risk management side of things is very important, making sure that when you've initiated the trade that you've got your stops in place and that you activate those stops accordingly when price is moving against you. On the opposite side of the ledger, it's extremely important that you let your profits run, and your whole expectancy at the at the end of the day is going to be a product of making sure that you're cutting your losses short, making sure that you are allowing your profits to run for as long as possible, capturing as much profit as you can, being patient along the way. Your best trades will absolutely take time to evolve, and it will also be a product of your strike rate. Now, when market conditions deteriorate, your strike rate is going to go down. And one of the things you will have been finding out recently is that the number of results you get on your scans are starting to reduce as well. So that in itself is a bit of feedback about market risk conditions along the way. Certainly worthwhile going through a number of your old trades and having a bit of a look whether or not you've actually managed those trades accordingly. Have you been able to milk those trades for as much as possible, or have you got out early because of some round number or whatever it may be, some preconceived idea that the price was going to stop at a particular level? It's very, very important that you let your profits run, and this is particularly so in a bull market. That bull markets will last for a period of years, and it's during those times that if you're diligent with your trade management, that you'll certainly be able to bank some very sizable profits along the way. And therefore, when we get conditions like we have now, that certainly we will give some money back to the market. That's only natural. But at the same time, you've boosted your overall level of expectancy. I'll just bring up a chart on Beyond Charts, just as an example at the moment. This was a setup in Fisher and Paykel. Now, it's a long time ago. It's in 2013. But I think it just goes to reinforce the importance of price action to start with, and not be afraid of missing trades where they've been going sideways for a period of time and then moving out from a stagnation zone, if you like, moving onwards and upwards and seeing some really nice price formation along the way. Obviously characterised by rising troughs along the way, and certainly very strong relative strength. It's interesting to see in the Australian watch list at the moment that there's still a number of stocks that are holding up very, very well because of this whole relative strength concept. So it's certainly not to be, forgotten about, if you like, because the whole concept of relative strength is about momentum, it's about money flow, and that's really just tracing the footsteps of the bigger institutions, if you like. So certainly from a fundamental point of view, there must be something about particular companies that they're really liking. So this is Fisher and Paykel way back in 2013. The reason I've drawn in the green line there, and this is to do with the whole concept of reward to risk. If we set targets of 1-to-1, and now traditionally we've always looked at 1-to-1 as being a minimum target objective, and it certainly is a minimum target objective. We wouldn't want to place a trade with anything less than a 1-to-1. But the best procedure in terms of the structure of your trade is to always be looking for objectives that are at absolute minimum of 1-to-1, but more preferably closer to 2-to-1. And the reason for that is that if you've got a target of 1-to-1 and that target has been, if you like, decided upon based on a longer term peak, as an example, then you're going to find that you're going to have to get through that target, that 1-to-1 target, on a pretty regular basis to keep up any decent level of expectancy. Because if you're hitting 1-to-1 targets at long-term peaks and you are finding that momentum really starts to suffer at that particular point in time, and the trade therefore has a retracement and swings back down and happens to stop you out, then you really haven't achieved much along the way. By that stage, you're really only getting your stops close to break even. And as a result, you're going to need an extremely high strike rate just to maintain a decent level of profitability. So certainly keep that in mind when you're looking for trade setups, to be trying to look for ones. Obviously, if you're looking at stocks that are in blue sky, then you don't need to be thinking about those sorts of targets. But certainly any time where there's overhead resistance, always be looking for something that is 1.5, 2-to-1 as a minimum, because they're the sorts of trades that are going to progress towards their targets, if you like, a little bit more fluidly than setting a target at 1-to-1 and then potentially having a further impact through a long-term peak coming back to impact on that trade. So look, I hope that makes sense. It is extremely important. I can't stress it enough that you let your profits run. It's very difficult to do sometimes in market conditions like these, but again, We don't know what's going to happen in the markets any time soon. Certainly the trades that have been knocked out of the watch list as a result of being knocked out of the watch list, it really is just saying, look, we don't want to be adding any more positions to an existing portfolio. It's really only for those of you that perhaps are starting off in the market right now. Other than that, your market risk indicators are telling you, look, stick to your guns. Don't go taking profits off the table unnecessarily, because again, that's not going to help your overall level of expectancy. And it is a difficult thing. Your mind tells you to, or your emotions tell you to do one thing, but you really need to keep things very, very simple and sticking with your trading plan. So I just want to go back and just quickly recap on what we've covered there today. So first of all, making sure that we've got all our trends in alignment. Again, our scans do that. Making sure that we've got a medium-term uptrend in place. Making sure that we're in motive phase, so we understand the difference between stagnation and motive. We're really wanting to make sure we've got really strong price action. Each of the troughs that are subsequently forming are well above the second from last respective peaks all the way through, so really good strong price action. Wanting to make sure that we've got a risk reward there, thinking about barest of minimum 1-to-1, but ideally you want to be looking for 1.5, 2-to-1 as a minimum, because that's going to help with your overall profitability and your overall expectancy, which is generated over a number of years. Okay, you've got to keep that in your mind as well, that you're trading and investing. You're not doing this for 6 months or 12 months. You're really looking over the next 6 years, 12 years, 20 years. And if you do this really, really well, then you're going to make lots of money when the markets are in the appropriate mood. You're going to donate a little bit back when they turn around and start going the opposite direction. But the net result is that you're going to grow your account very, very sizably, in particular when markets start to deteriorate. You're actually going to outperform by being in cash and sitting on the sidelines waiting for the next opportunity. Your breach signal or your breakout trades, setting the order on stop 0.5% above the last medium-term peak. So again, that helps us to remain consistent and appreciate that not all stock prices are equal. I.e., a stock trading at $1.50, entry levels on that using 0.5% are certainly going to be different than entering a stock at $100, $200, $500 using 0.5% as well. Still using a limit there of 1% above that point of supply, above that last medium-term peak to minimise slippage. So again, providing a window. The other aspect about 0.5%, where this fits in very, very nicely as well, if you think about it in terms of where we're going to place our protective stops need to go at least 0.5% below the last medium-term trough. So that whole 0.5% thing is it's a consistent measure, if you like. So stops being at least 0.5% below the last medium-term trough and outside of your 2 ATRs, and your entry levels being at least 0.5% above the most recent medium-term peak. So, folks, that's it. That's the subtle change. I don't think it'll make a great deal of difference in terms of people understanding the rules, etc. But certainly, if you've got any questions, feel free to give us a call in the office or shoot us an email or request a coaching call. Are there any questions before we finish up today? Hopefully everybody's still managing to trade well, those positions that you've got, managing to stick to the rules. Very important that you're consistent and ticking the boxes as you go through. It's a challenging environment. It's very difficult to do. And Kay's asked, can you have a copy of the sheet? Absolutely. What I'll do with the trade setup conditions checklist is I'll get it published on the website. It'll be in the download section under the ETC portal. So I'll get that up there ASAP so everybody can have a copy of that and have it next to their computers. All right, folks, we'll leave it at that. We will be doing a weekly macroeconomics session. We'll record that tomorrow. We do have a holiday in Victoria this week. The government's given us a holiday so that we can go and watch the grand final parade of a Friday, which is very nice of them. So that will be being sent out tomorrow as well. But other than that, I will catch up with everybody on Monday morning for the the weekly analysis session. Have a good weekend. Thanks, folks.